All right, so last time we were talking about non-monetary exchanges. And of course, the overall idea that we have here is that we're no longer using only cash as a means of exchange. And we've looked at other cases where we're exchanging instead of cash, a promise to pay, a note payable. We've also looked at cases where rather than cash, we're issuing equity stock. And so this is just another case where we're doing an asset. You know, we looked at an asset with cash, a liability with the notes, equity with the common stock issue. And now we're looking again at assets, but not a cash asset. And, you know, it's still really based on this idea that the only things we have to determine what we want to record the new asset at is what we gave up, right? That's typically what we've been using, with a notable exception in the equity. If our equity is private, if it's hard for us to assign a value to the equity, then we might base it on what we receive. But every asset acquisition revolves around this question: do I want to choose what we gave up as the basis to value what I'm getting, or can I put a value, a better, more reliable value on the thing we're receiving? And in most cases, it is what we gave up, because the things we're in possession of, we tend to have a better idea of their value. And so that forms the value of our new assets. Also discussed about when you exchange some cash in addition to giving up an asset. Well, in that case, really, you're just giving up two assets at that point. If you're paying cash, you have your old asset that you gave up, and then you paid some cash. And since you're giving up both items, then the new asset's value is just the sum of those two things. Notice we're using the fair value of the asset we gave up, not its book value. So we're basing it on the fair value of the asset we gave up plus any cash paid. When we go to the new, if we are being paid cash, if we're receiving cash, then we look at the fair value, still the fair value of the asset that we gave up, but then we subtract off the cash we received. And that is the easiest way for you to remember that, in my opinion, is to think about, all right, I gave up an asset and they're giving me an asset. If they're giving me an asset and some money, then that must mean that my asset was worth more than theirs by the amount of money. Otherwise, they wouldn't have had to pay me that additional money. If I have a car and I'm exchanging it with another company and they're giving me a car and they're giving me their car plus $5,000 cash, it only stands to reason that my car by itself was more valuable than their car by itself. Hence, they had to give me that extra cash. And so whatever the fair value of my car was that I gave up, I would just subtract off that cash received. So that's the basic valuation for how we handle these items. And we use the fair value when we are recording a exchange with commercial substance. And I talked about that briefly the other day, that commercial substance indicates that this exchange is going to change the cash flows of the company through this new asset we've acquired, i.e. this asset is of better quality in some way. It has a longer useful life. We could use it longer in the operations of our company. It will enhance the cash flows, the revenues that we can generate as a company. And so that's what commercial substance means. And commercial substance plays a role in some of the things that we're going to record. One of the things is that we base our new asset on the fair value of the asset we're giving up. Another place commercial substance comes into play is recognizing a gain or loss on exchange. Now, regardless of commercial substance, we always recognize all losses, and that's regardless of whether there's commercial substance or not. And gains, we only recognize with commercial substance or if cash is received. So there's a sort of two-part determining factor as to whether we recognize a gain. Is there commercial substance? If there is not commercial substance, then we go to criteria 2. Did we receive some amount of cash? If we did, then we still might be able to record some or all of the gain. But it's not like losses where we record the entire loss regardless of whether there is or is not commercial substance. The other thing to remember is that when we calculate that gain or loss on the exchange, we are calculating the gain or loss solely based on the relationship of the book value and the fair value of my old asset, the asset I'm giving up. If its fair value is less than what I have recorded on the books, basically that means that what I could sell it for, the fair value, is less than what I have it recorded at historical cost minus accumulated appreciation on the balance sheet. If that's the case, then we have a loss on the exchange. If my historical cost less accumulated depreciation on the balance sheet, the book value of my old asset, is less than the fair value, so I go and sell it, I could sell it for more, then I'm having a gain on this exchange. But the whole transaction, gain or loss, is based only on what I'm giving up, right? And the value, the market value of what I'm giving up versus its book value. The journal entry makes it a little bit more confusing, as I mentioned, than I believe it really needs to be. There's a lot of things like you're definitely going to debit a new asset. You're definitely going to debit accumulated depreciation of the old asset. And of course, the reason why you need to do that is accumulated depreciation is a contra account, which with a credit balance. And so in order to get it to zero out, we need to debit any balance in accumulated depreciation to get rid of the accumulated depreciation with that old asset. The old asset's historical cost would be credited because whatever asset it is, if it's a building or if it's just equipment or what have you, it has a debit balance. And so in order to zero that out, we need to credit it. And it's important that you do the historical cost and whatever depreciation there is. Don't just do a single credit for the book value of the asset. I mean, you're going to still have debits and credits balance. If you're doing that, though, you're netting this historical cost with this accumulated depreciation, and that is not how it's being kept in the ledger. So it's not really appropriate. The items I have highlighted here, it doesn't come off as highlight, but just a very faint gray box. These are conditional, like you may not debit or credit cash at all, just depending if it's part of the exchange. Of course, if you receive cash, you debit it. If you pay cash, you credit it. There will be a gain or I won't say there will be. There could be a gain or loss there on the exchange, depending on the commercial substance. But if it's a gain, it's always a credit. If it's a loss, it's always a debit. You never, if you're crediting a loss or debiting a gain 9 times out of 10, you're probably doing something incorrect. All right. There are a few, we'll get into this whole idea of, maybe we can recognize gains without commercial substance in a second, but I want to take us to an example real quickly and just look at how this can play out. I will put this on, I'll put this example in the notes module. This is just something from some of the in-person assignments I have. So we have Rough Buckets, a company that's exchanging a number of tractors with an original cost of $750 and accumulated depreciation at 375 for another group of tractors from another company. The fair value appraisals estimate the old tractors on Rough Buck's books at $400,000. We received $25,000 as part of the deal. The exchange has commercial substance, and so we're supposed to record the journal entry for this. So with this, the very first thing I do, if you recall from my strategy yesterday, is determine, is there a gain or loss on exchange? That's my first question. Then I can figure out whether I want to recognize that gain or loss based on the presence or absence of commercial substance in the case of a gain. If it's a loss, I know I recognize it no matter what. So I'm comparing the book value of the asset I'm giving up. I have an original cost of $750,000. I have accumulated depreciation of $375,000. So looking at those T accounts, you don't have to do this, but until, I think some people are probably still in need of this. And some people are just ready to kind of take off the training wheels and not have to worry about mapping this stuff out. But until you get it, make sure you're mapping it out. So we have a book value of that much and an accumulated depreciation of that much. That means that we have a book value, I'm sorry, not book value, historical cost of $750 and accumulated depreciation of $375. The book value that we record this at then on the balance sheet is the historical cost minus the accumulated depreciation. These, of course, come together. This is the parent account and the contra account, and that's going to be $375,000 of book value. We look at its fair value, and the fair value of these is $400,000. And we're comparing the book value that we ended up with the fair value we ended up with. In this case, since fair value is greater than book value, it's a positive surprise, right? It's kind of like thinking, I thought my car was worth $50,000, but hey, it's worth $70,000. So that's a gain situation. 400,000 minus 375,000 gives me a $25,000 gain. And I wouldn't recommend doing the oh yeah, take this number minus this number. If it's positive, it's gain. It depends on how you order the numbers, right? If I took book value minus fair value, I would have gotten a negative number. It doesn't make it a loss. Think of it more in terms of, what do I have it recorded at on my books? This is my expectation. What could I sell it for? This is the sort of happy surprise. Right? If it was less than 375, it would not be a happy surprise, and that would be a loss. All right, so we know we have a gain. We also have commercial substance. So since we have commercial substance, we can recognize gain because of the commercial substance. So that makes that part of it easier. We'll look at the second part where it doesn't. I just changed that one aspect and how we have to kind of think through it a little bit more. So I start by making my journal entry. I definitely have a gain on exchange. And I know I can recognize it and put it in because I have that commercial substance. And now the next thing I do is remove the old thing I'm giving up. So in this case, I'm getting rid of the tractors, right? I need to credit this by $750K. I need to debit accumulated depreciation by $375,000. And that gets me at my $0 balances. So I credit the tractor. So those are the old tractors that I'm getting rid of for $750,000. These new debit accumulated depreciation for $375,000. And also, okay, so now I got that taken care of. I removed what I'm giving up from my balance sheet. Also, I received some cash. Don't forget the cash piece. I received $25,000 of cash from this transaction. So I would debit cash for $25,000. And at that point, the only thing that's yet to be recognized is the new tractor. So then we got tractor, and it's a new one. And it would just be for whatever makes my debits and credits balance in this case. So we got $775,000 of credit here. We have $400,000 of debit. So my new tractors then would be recognized at $375,000. Okay. That's how I tend to work these problems. Now, from the notes, you have that formula about like, well, the new is based on the fair value of the old, plus any cash I pay minus any cash I receive. And that is true here because the fair value of my old asset was $400,000 and I received cash. So I subtract that. And that does give me the amount that I would record based on what I gave up and the fact that I received $25,000 of cash in the exchange. But to me, it's easier to let the journal entry show me the exact amount by filling out everything until I get to that new tractor. All right. So that's the first part. The second part says, if the exchange lacked commercial substance, but everything else was the same, how would Roughbuck account for this transaction? Well, so basically everything's going to remain the same. The fact that I received cash, the fact that I had this much accumulated appreciation, this amount for the old tractor. Now, what is going to be different though is the determination of whether I can recognize a gain on the transaction. Now remember, the gain is contingent on the commercial substance first. So do I recognize the gain? I know I have a gain because no other facts of the problem changed. It has a fair value of 400, an accumulated book value of 375. So there is a gain. The question is, do I want to recognize it? Is there commercial substance? And that's the very first question, because if there is, then I can recognize it. But in this case, I cannot base it off this question. So now I have to go to the second question. Was cash received? And in this case, yes, it was. And now I can either recognize if the answer to the commercial substance is yes, then recognize the entire gain. Just like I did above. All $25,000 of that gain gets recognized if it has commercial substance. If I recognize it because of the second criteria, then I have to do a little bit of calculation to determine whether I want to recognize all or part of the gain. And the determining factor on that is going to be looking at what is the value of the cash that I received in proportion to the total value of what I received. And so I had $25,000 of cash that was received, but I received not only the cash, I also received a tractor that I ultimately will value at $375,000. So if I got in total $400,000 of stuff, which is related to what I gave up, the fair value of what I gave up, then what proportion of that amount is the $25,000? And so if I do a quick calculation with my phone, which I seem to have lost, okay, I'll do it on my computer instead. 25,000 divided by 400,000 is 6.25%. Okay, so now I know that the amount of cash I received is 6.25% of the total value of things that I received, the cash and the old tractor. If this was greater than 25%, of the total value of what I received, then I could recognize the entire gain. If I don't get that amount, if I don't get 25% in cash, then I only want to recognize that amount of the gain. So I only recognize a percent of the gain if it's less than a quarter of the total value of what I'm getting. In that case, I have to take the 25,000, multiply it by 0.0625 in order to figure out what is the amount of the gain that I can recognize in dollars. And it says that I can recognize, this second, let me make sure that's right. Yeah, $1,563 if I round. It's like 1,562.5, but we'll just round it up to 1,563. So that's what I can recognize. Everything else would stay the same. Of course, something has to change because I can't just plug in 1,563 here. And the other thing that's going, the only other thing that can slip or move at all is how I value the new tractor. So I recognize the gain on exchange at the lesser amount, only 6% of the 25,000. The old tractor still had a historical cost of 750,000. So that's going to stay at that amount. The accumulated depreciation was still at $375,000. That doesn't change. The amount of cash I received was 25,000. That doesn't change. And now, like I mentioned, the only thing that could change to keep debits and credits on equal terms is to let the new tractor be of a different value. So now we have $400,000 of debit so far. We have 751,563. So the new amount's going to be $351,563. So I record a little bit less of a gain, and I also have a little bit lower value on the new tractor because of the lack of commercial substance, right? The economic value of what I'm getting is somewhat reduced because there is no change in my future cash flows. Because there's no change in future cash flows, the gain is only recorded in correlation to the amount of cash that was part of the deal in the transaction. And so that's how we record gains when we lack commercial substance. If the answer to number 2 is no, if we paid cash or cash was not part of this transaction at all, then we just don't record a gain. It's off the table. If we have the commercial substance, we record the entire gain and always record a loss, whether or not there's commercial substance. And that that sort of asymmetric treatment, right? That that inequitable treatment between the two, that we recognize a loss every time, and we only recognize a gain when we have some future alteration to cash flows because of the addition of this new asset to our company. That is an instance of conservatism. We're more likely to recognize losses. There's a lower threshold for recognizing a loss than there is for recognizing a gain.